In the AFE video, we looked at some pretty eye-popping prices on the various well drilling costs. And now, as we shift into looking at the lease operating expenses, I have this fascinating report that's out of the Dallas Fed to help us understand orders of magnitude. This survey was done in the spring of 2017, and they asked 62 E&P companies, what WTI price do you need to profitably drill a well? And they looked at it by play, and you can see the results in this part of the chart. The way you interpret the graphics is this was the highest price they heard for the Permian Basin and the Midland area, and this was the lowest. So you see, I'm kind of surprised at how much variation. There were some people saying they needed $65 barrel oil, and some people saying they needed $25 barrel oil. That's to drill a new well. So considerable variation. You can also see that Oklahoma, the scoop and the stack, is very competitive. I'm surprised that the Eagle Ford was on par with the Delaware Basin and the Central Platform, but it is what it is. Here's the principal reason why I wanted you to look at this graphic, though. If you see if it takes $46 a barrel to drill a new well, this is results that says, okay, assuming that you've drilled the well, how much do you need the oil price to be just to cover your operating expenses? And you can see, again, basically the same trend. A little more expensive to operate in the Permian, Delaware, and in the Central Platform. You can see there's about a $4 price jump, but this is relatively the same. And if you compare it, it's about $20 a barrel different. So you can see that in general, it takes about $20 to drill and complete the well in price of a barrel oil, but it takes an even greater percentage or even greater number, 24 and upwards, to operate that well. So that gives you a feeling that these operating expenses are pretty doggone significant. So I'm going to pause the video and switch to a printout of some lease operating expenses. This is information on lease operating expenses that one oil company was generous enough to share with me. Excuse me. And everybody has their own layout, if you will. This is just how they do it, but it's a very easy layout to understand and very easy for me to walk you through it methodically. At the very top, they talk about the sales. So a good income statement, it first starts with revenue. It tells you what their sales were of oil, gas, and natural gas liquids. This well was obviously all oil. One of the things the way this particular company does it is when you see the oil, that is their share of the oil. In other words, the royalty's already been removed from the oil production, as have their other working interest partners' shares of the oil. This is their company's share of the oil. So it's not a picture of the well as a whole. It's a picture of their share of the well. But again, that's a very logical way to do it because the expenses for the working interest owners are shared proportionally, so it makes sense. You can see that this well made about $500,000 in revenue over the course of the year. You can also see that it did so at a time when prices were down quite a bit. I'm trying to see on here where it talks about the prices. Maybe I just know that this was a period, they went through some periods where the prices were pretty low, but I thought there was a place here where they told you what their price was per barrel. I'm sorry for having to look. I guess oh, here it is down here. This is the price they actually got. And you can see this was during the period when oil prices hit their lowest point. So this is the income. Then you see from this revenue of $484,000, they start with the deductions. First is the production taxes. So these are what's called the severance tax. Varies state to state, as you're going to see in another product. It varies surprisingly widely from state to state. So then they subtract out their taxes, and then that's their total revenue. Then they get into their lease operating expenses. Let's just look at the categories over here, and then we'll see what they look like in terms of orders of magnitude. This would just be if it was a non-operated lease or they didn't have good breakout, how much their total bill was. Fuel, this is if you have, for example, diesel generators on site, how much does it cost to keep them fueled? Equipment rental, whatever equipment they may renting to be put on the surface. Roustabout third-party services, this is just paying people to do workovers on the well. Utilities, this typically is electricity, could be natural gas, to the pad to power the pump jack and whatever pieces of equipment that you need to power. Supplies, repairs, this is where you would be paying a company to go in and do some repairs. Pumping, this is where you're paying a pumper. You're paying somebody to keep daily track of the wells. Most wells are checked up on every day by a pumper, and they're the ones just basically keeping an eye on things. Chemicals and lubricants make sense. Water disposal. You're going to see that in all of these wells, water disposal isn't a very significant cost. That could be because the well is not making much water, or it could be, which I think is true of the case of these particular wells, they actually have drilled a disposal well on site, and they're disposing the well that they get from the production and putting it right back into the ground on the lease. In other cases, people are actually using the water to do their own water flood. But this can get quite expensive if you have to haul it off. Very much location dependent, but a rule of thumb would be that if you have to have water hauled off site and disposed of elsewhere, $2 a barrel of water. So you could see if you're with a well that's making an equivalent number of barrels of oil and barrels of water, that you would just be decrementing your profits by about $2. But what if you've got a well that's producing 5 times the amount of water that it is producing oil? And those wells are certainly out there. In fact, we're probably going to visit, when we visit a lease, we probably visit a well like that. Then you can see that number could quickly become pretty doggone impressive. Rig service rig, this is again for workover. I apologize for the highlight. I hope it doesn't obscure too much. This is administrative overhead. There, COPUS is the Council of Petroleum Accounting Society or something like that, but it's the accountants. They've come up with a standard percentage that you can charge based on the revenue for the overhead. And so you can see they expense out the overhead. Insurance, not insignificant, and then taxes, property taxes. These are what's called the ad valorem tax. So once you have production, needless to say, the counties want to tax that as a property and charge property tax. Commonly it's called ad valorem tax. And not a terrible sum of money, but it's all adds up. When you come over to this column, you can see for this particular well, they're paying they probably did a little bit of workover because they paid a fair amount of money to Roustabout third-party services. But look at the utilities, very high utilities. Keep in mind, basically their utilities were over a quarter of, or right at a quarter of their actual total revenue. The reason for this could be, I think the oil company told me that they are doing wastewater disposal on site. They have a disposal well, but they have to continuously run pumps to pump the water down. And that might be in part why the electric bill is so high. Here you can see they pay a pretty good fee to the pumpers just to go pump the oil. Chemicals pretty high. Obviously the overhead is there. Taxes, nobody likes to pay taxes, but they're manageable. So that just gives you a sense for this well of what you're looking at in terms of operating expenses. If we look at the other wells, the pattern is relatively similar. You can see here the utility expense isn't nearly as high, but then again the production isn't nearly as high as well. And some of the other services aren't as high. So this well actually shows, even though it's on much less revenue, it shows a much higher net income. And again, same picture here. This is even in terms of to this company, an even smaller revenue producer, but because their share of the expenses are proportionally relatively low, they make a nice sum of money off of that well. What do I expect you to remember off of this discussion? I want you to remember just how significant the lease operating expenses can be. And I want you to realize that some of the major elements of the lease operating expenses, utilities, taxes, paying for the pumpers, if you have to do water disposal, how expensive that can be. So now we've looked at the costs to drill a well, and we've looked at a cost to operate the well. Now what we're going to do is, in the final video, we're going to look at a tool that, a very simple tool that companies can use to make a decision as to whether this particular well is worth drilling or not. Join me for that.